All right, we're going to do it. The coronavirus episode. And yes, at the time of this recording, which is March 12th, it is still very uncertain how this is all going to play out. So it may be the case that we do many more episodes on this topic. Only time will tell. And I'll keep it brief because I know everyone is very eager to get into this discussion. So in this conversation, we're going to talk about our guest, who is a trained economist's outlook prior to the coronavirus, and then how the coronavirus outbreak, or at least the headlines, have really impacted her outlook on 2020. We're going to talk about what a coronavirus-caused recession could mean for real estate. Now, the area of recessions and real estate is something that our guest has spent a lot of time contemplating and studying, and she's well positioned to answer at least part of that question, with the coronavirus really being the X factor that no one really can predict, at least at this point. We're going to discuss the cities which are most exposed to risk in terms of coronavirus stuff, and why those real estate prices may struggle in a market that is being significantly impacted by coronavirus. Also, I give a brief summary of the different asset classes that I track and my thoughts on which ones are best protected and insulated from that risk, and which ones may see some real serious struggling. Now, of course, there's a lot of uncertainty surrounding how this is all going to play out. Our guest brings a ton of data and historical context to the conversation, but it's just one of those things that is pretty unpredictable. It's easy for us to wait 3 months and then do an episode about why all the things that happened, and we could easily claim that we knew it all along, but that doesn't really help you as investors. So we're going out on a limb to try to look into the crystal ball that doesn't exist in an effort to help you, our listeners. Now, if you're an accredited investor, don't forget to sign up to ASYM Capital. That's ASYMcapital.com. You can get instant access to our live deals. This coronavirus stuff could certainly create some buying opportunities that I know a lot of you have been patiently, or not so patiently, waiting for. Also, I recently launched a business Instagram, and we're going to be giving away an iPhone 11. That's right, iPhone 11, which I don't even own, by the way, as soon as I get to 1,000 followers. So I currently, as of the recording of this, have 431 followers. I just launched it. So if you go over to Instagram, shoot me a follow at Hunter L. Thompson _ for a chance to win a brand new iPhone 11. All right, hope you enjoyed the episode. How's it going, everyone? Our guest for today is Ali Wolf, who is the Chief Economist for Meyers Research. And at that role, she manages and analyzes the content for Zonda, provides data analytics, runs special research projects, and does presentations across the country on topics spanning from both the housing market and the wider economy. Prior to joining Meyers' team, she worked for a consulting firm and was researching topics for the Canadian and UK parliaments. She has a bachelor's degree from the Ohio State University in economics and a master's degree from the London School of Economics in real estate economics and finance. Plus, she has been a guest on this show before, episodes 38 and 85. Both are really quality. We got a lot of really positive feedback, particularly on episode 85, where we talk about the implications of the yield curve inversion and what that means for real estate. So we are so excited to have her back to talk about this unbelievable topic that has just got the media buzzing, and honestly for good reason. So Ali, thanks again for joining us.
Thank you so much for having me back. This is a crazy world we're in right now.
That's right. In fact, we were just kind of talking offline. When I originally sent out the email request to talk about the coronavirus, it was not in jest or anything like that, but it was just kind of, it was talk of the town. This is what people are kind of most concerned about. This will be an interesting topic. And just even since the few weeks that I sent that original email, now it's clear that this is a really significant challenge, potentially for a lot of different industries, potentially for a lot of different markets and sectors. And it's a massive, massive question mark, a genuine massive question mark. So that's what we're going to talk about today. But before we do that, I want to provide a little bit of context in terms of your thoughts on the economy prior to, the last month or two. So let's start with that. I think that'll be a good starting point, and then we can jump into the details. So prior to these headlines about the coronavirus, what was your economic outlook, and what were you most focused on when making that outlook?
Well, and I'm almost a little embarrassed to say that I went through probably 7 presentations just in the past month. And in all of them, I said, you know what? We've revised down our recession forecast. We had lowered it to a 25% chance that the U.S. would enter a recession in the next 10 months. And most of the data sets that we were looking at looked positive. We like to look at consumer confidence, but we like to look at it via Google search activity. And so we were seeing really a diminishing response of like, when is the next recession? Or is the housing market slowing? We were obviously still seeing the labor market. Our biggest concern going into this year was that CEO confidence and consumer confidence was completely on two different sides of the spectrum. You had consumer confidence that was at the highest level it had been throughout the cycle, and you had CEO confidence levels that were at the lowest level this cycle. So I think that was our biggest cautionary tone was consumers can feel great. They can feel like they have a job and they want to go out and spend money. But ultimately, our livelihood comes down to the employers who make the decisions and who give us the money to spend. And so that was our biggest tone of caution going into the coronavirus.
Yeah. And now a lot of things have changed. So what does that look like now? I mean, obviously, it's every single day there seems to be some significant developments. So I'm not sure if you've been able to actually change those, revise those numbers regarding recessions. But what are you looking at? What are you most concerned with given these recent updates?
I think right now we're trying to use logic over data. And to me, logic is saying if we are not going to the mall, I've been to like a couple malls over the past few weeks, there's no one there. If we're not going as much to restaurants, if we're not now going to the NBA, to different games, we're not going to concerts, we're canceling conferences. I've had a few speaking opportunities that they've said, hey, never mind, we don't want you coming because we canceled the conference completely. I don't know how that doesn't slow the economy. To me, each of those individual boxes, that is the economy. And so I think a lot of the data is eventually going to change. And it's a shame that we're not going to see it for a few months, because even if we see a good reading once or a bad reading once, that's not a trend. So I think we're still just trying to juggle it. I think the chances of a recession in my books has gone up compared to just a few months ago. And I hate to say it, but I don't know how we can have all of these factors slow and the economy continue to chug along.
Yeah, I mean, there's so much capital moving around, particularly at events, particularly at conferences. I mean, South by Southwest was recently canceled. That brings about $350 million to the city of Austin every single year. And that capital ripples through the economy. You mentioned the NBA, for example. That's not just that the NBA players aren't playing. Right? Those are massive, massive events, which usually bring millions of dollars on a weekly basis to these stadiums with those employers and the vendors that are associated with that. My wife is in the event production business, and it's a 2008 type of situation for her. You know, the conferences that she's doing over the next 3 months are being canceled, and those deposits are in question. And it's a really, really massive, massive question mark going forward.
Yeah. And even when you look at some of the retail, I was talking about going to the malls, when you go and you spend money, it's not just that you're helping that salesperson that's on the ground. That's going all the way up, all the different management chains, all the way up to the top of the company, goes back to the CEOs who are already concerned. Now they start seeing their numbers changing. Now they start to say, maybe it's not mass layoffs, though we have seen a few headlines. Maybe reporters are looking for headlines of layoffs, so maybe it's not as bad. But you do think at a certain point they're saying, maybe I don't want to expand growth. Maybe I don't want to take on new investments right now because I just want to wait to see how this plays out.
So is it too early to talk about some of the data points that you focus on? I remember the first time we talked about it, kind of the recession indicators that you really focus on, the quit ratios, for example. Those data points aren't going to move as quickly as something like the headlines that may scare us. What are your thoughts on that? Or is there anything that we can see so far? Is it just too preliminary right now?
So we've been trying our best to just say, okay, what can we look at? What do we see? A lot of people that I've talked to that don't follow the space as closely as maybe you or I do, they're like, oh, well, the jobs report came out great. I'm like, okay, that's fine. But that was way before all of this started. I'm not sure. Like, yes, we came from a good base. And yes, we came from a strong labor market, which maybe can help cushion a little bit. But that's not the number you should be looking at. Initial jobless claims came out last week. And when they came out, they were still positive. And so you're looking at these and you're like, okay, well, something's not adding up. And I think it's that the data is not capturing things yet. I thankfully haven't had to, and knock on wood, apply for unemployment benefits, but I don't know how quickly it happens. Do you go and right away you can do it, or is there a little bit of a lag between that? Again, the only data that I've been able to look at, well, the financial markets, of course, and you just, again, have to use logic of what does it mean if people have their money in the stock market. Now the stock market's down. Do they still have money for a down payment? Do they still have the wealth effect that they did a few months ago? Probably not. But we also still look at the Google search activity. To me, that's the only real-time data source that I can get access to, because it is literally what are we doing right now. As it relates to the real estate market, we've seen that people searching for, quote, should I buy a house, is at the highest level it's been since they started tracking the data back in 2004. Now,
wow,
does that mean they're going to buy a house? I don't know. So I think that's like the next question mark is, why are they searching it? Are they searching it because rates are low? Or are they searching it because they're concerned and they don't know if they should buy a house? Maybe the answer is both.
Interesting. I would not expect that. That's really interesting. And I have to imagine that it has a lot to do with those rates. We can talk about that in a second, but we recently got a Fed funds cut, the Federal Reserve cut rates, I should say, it's more accurate. And that obviously trickles through into the mortgage business. And now rates are basically at all-time lows. And so we're seeing massive, massive increases in refinances. But to actually contemplate buying a house because of rates, in my opinion, is a very different ballgame, especially because if you already own a house and you're like, well, there's money leaving on the table, I could save $1,000 a month on my payment. That's one thing. But to say, let's move out of this apartment to buy a property, that's a completely different kind of conversation.
Yeah. And we've seen from some of our clients, it's been really mixed. I've been trying to call a lot of our friends, a lot of our clients are builders, and I've been calling them like, hey, how's traffic? Are people still coming? And it's a completely mixed bag. It doesn't even matter location. It doesn't matter price point. I'm just hearing kind of this mix of like, we're seeing traffic come and we're seeing people are touring the communities and they're excited about low mortgage rates. But equally, I talk to a lot of people that say, again, as an industry, we follow rates like, well, it is our job. And so we follow rates so diligently, but an everyday consumer isn't necessarily as aware of it. And so I think that's the struggle too, is people come in and maybe they were going to look for a house anyways, but then the agent or whoever needs to create that urgency that, hey, rates are low and this is a huge opportunity to buy a home.
For sure. Let's circle back to the conversation about the stock market, because the stock market is interesting, right? A lot of really wealthy people have a significant portion of their wealth in the stock market. Then there are people that don't have a lot of wealth that still use the stock market as an indicator as far as how well things are going. It may not have anything to do with their job or their net worth, but it's just a matter of what the overall feel of the economy is. So when I see a significant correction in the stock market, I assume that there's going to be less purchases, especially in the luxury market, especially in residential. There's going to be less activity, less volume. People would most likely stop because they're concerned about, they want to go in the defensive. Is that accurate based on the historical data, or is that something that just makes sense and isn't really true?
As I understand it, that's quite accurate, is that people are looking at the stock market, again, whether or not they have money in equities, they think stock market equals economy. And I normally would say, the stock market is not going to guide the economy and you don't need to pay that much attention to it. I think the two may be moving in the same direction this time around, because I do think that investors or algorithms are reacting to some of the ideas of what will profit and revenue look like when we have our next earnings report and how are these companies going to fare. So I think there's a little bit more of a linkage between the two today. But I do know that I have a lot of friends that studied just, psychology or English, and they've never really cared about the stock market, but they're texting me like, what does it mean to be in a bear market? And should I be concerned about that? And then if they start thinking about it, then they're like, okay, well, maybe I want to, keep some of my money, just be a little bit more cautious with how I spend my money.
Yeah. I think this is actually an interesting data point, because prior to the popularization of the internet, I don't think that phenomenon was that common. In the sense that there's so much, the immediacy of the information, the immediacy of something like the inversion of the 10 and the 2 year happening, people say, okay, this is a thing that we should be contemplating. This is a thing that we should be focusing on, and everyone's focusing on these same data points. And so I've kind of been under the impression that these corrections can be more pronounced. However, the other side of that is that people, again, prior to the advent of the internet or popularization of the internet, people weren't really thinking, okay, if there's a massive correction, I can buy. I've actually felt like that is something that people have been waiting for. There's been all these memes about, millennials waiting for a recession so they can buy a house. I'm not so sure that was as popular just, 20 years ago. And I know that we're being kind of anecdotal with these conversations, but the point is we're trying to front run the data to your original point.
Yeah. Yeah. And that point is so exactly right now. I just was, before we were on the call, I was on LinkedIn, and a guy that I know was like, hey, just so you guys know, this stock lost 30% of its value. If you're not buying it right now, you're an idiot. Like, everyone's saying, this is it, buy the dip. And I think a lot of people, especially on the younger end, the millennials, to your point, the fear and the saying is catch a falling knife. But if your time horizon's long enough, I think some people are saying, well, it's okay because, maybe it will go down a little bit more. Maybe I'll buy a little bit more at that point. But 20, 30 years from now, it's going to be back to where it was and then some and then some. So they're not as concerned. For the housing market, too, you make a really good point that we actually do have data on, to not just be anecdotal. We survey millennials every year. And one of the questions that we asked them this year, which I've never done before, but I said, how concerned are you about a recession? And I think the number was like 70% were an 8 or 10, 10 being the most concerned, 1 being the least concerned. 70% were between an 8 to a 10 of most concerned. But then I gave them like this free-filled Dropbox, just tell me what you're thinking, just broad ideas. And I went through each of those responses, and so many of them were, can't wait for the drop, can't wait for the drop. When the drop comes, I'm going to go out, I'm going to buy a home, I'm going to take advantage of the lower prices because prices have gotten pushed up too high. That's assuming they hold their job and some of their money wasn't in the stock market and everything that they had financially been saving up for the drop is still in the right place.
Oh yeah, that's a really good point, that last one, because while it is true that a lot of millennials have gone through 2008, they didn't go through it in the way that adults went through it, in the sense of if you don't have a mortgage, if you don't have children, if you don't have car payments and you go through a recession, it's not the same because the pressure is just not there. And so it's easy to say, oh wow, like that was such an amazing time to invest in real estate. And I've tried to harp on this to prepare people emotionally for what that means. But when the sky is falling, it's not like, hey, great, look, prices are down. It's like, oh my gosh, my uncle lost his job he's been working at for 15 years, that kind of stuff. Let's talk a bit about what that means. So if this basically frees up to a large degree in the event business, in the travel business, in a lot of luxury businesses, does take place and there is a recession, what do you think that means for real estate in terms of volume of transactions, in terms of pricing, et cetera?
I actually can't remember if we discussed this on the last podcast that we did together, but we've pulled the stats to try to make sense of this number. And what we're doing is trying to use the past to determine the future, knowing that the past 5 recessions, different things caused them. There was, some were housing led, some housing was just kind of in the crossfires, but not really a cause of it. But what we've found over the past 5 recessions is that home prices don't have to fall. You kind of see a blend of home prices going down double digits, going down single digits, and sometimes actually increasing. And we've pulled that by market too. So we have a pretty extreme graph that shows prices can go down 50, 60%, depending on your market. And that's obviously the Great Recession that's bringing that down. But in a lot of markets, the average is for a steady, let's say, 8 to 15% drop in prices. That's what the past has shown us. I think in today's environment, we have a couple push and pull factors, though. The lack of supply, I think, has pushed up that price point. And you can argue whether or not that's artificial or not. Maybe that's just the nature of the world that we're in. But as we're looking at this, we also have a lot of pent-up demand. And so there are going to be sectors and there will be industries that are going to continue to be successful and they will be able to go out and buy homes. So I think part of it is we do have room for prices to come down, but part of it is when prices do come down, to our earlier point, if we have enough people that have saved for that rainy day and continue to be employed, then that can help soften the drop in prices.
Agreed. And I think you bring up a good point regarding the recessions and the correlation between real estate, et cetera. We did talk briefly about it, but this is something we did probably a year ago. We talked about recessions and things change, but I think people need to really understand that 2008, again, was the aberration in the sense that you had a massive seize up of the financial markets, which was to a large degree in the United States caused by the real estate market. That is not the way typically things work. And to see a 30% correction in real estate, for example, is way ahistoric. And this is very good news because if you have a property that you put down a normal 30% down payment on, if you have a 15% correction, you're still well protected and you're not making the decision, should we continue to pay this mortgage? At least if you're in a position to do so, right? If you're in the position to pay the mortgage will be paid because it's economically viable. What happened in 2008 is a lot of properties went underwater and a lot of those mortgage didn't get paid for economic reasons. Even if they had the money to pay them, they may have thought, we're putting money into the sewer, basically, by paying all this additional equity that's not there. So let's talk briefly about the particular markets that you feel may be very exposed, given the specific risk of coronavirus and the implications surrounding that risk.
And one thing I want to say before we jump into this is, as I'm listening to us talk, I'm like, wow, we are like so doom and gloom. And I think it doesn't need to be doom and gloom if we end up getting a vaccine or we end up getting this contained. I think we're right now talking at the height, well, I hope, the height of everything, where it's just like Tom Hanks has it now and the NBA is closing down and March Madness is doing this. And you're just seeing everything left and right. And it's hard to try to be optimistic when you're trying to weigh all of this. But I do think there are a couple cases where if we do see some changes in the data, we see things level out, we see the vaccine, we see short-term containment measures, but then it ends up helping the economy in the long run. This can be a short-term blip, and this is going to be something that we can get back on track. So I do want to not be, because I'm in the same, like every night I'm like, I can't even sleep because I'm like, this is a mess, everything's going bad, but there is an opportunity that things will get better. To that point, Seattle is on my watch list for sure. Seattle has, as I believe right now, the largest number of cases here in the U.S. And I have a coworker that lives in Seattle that 2 times a week, every week, he goes to the same restaurant. And he went to it this past week and said it was him and one other person there, when normally he's struggling to get a seat at the restaurant. And so, things like that, maybe people are, because they're not going to restaurants, shopping for homes, but I think that's a little Pollyannish to jump there right away. I do think that market is at a higher risk than some of the others.
Yeah, agreed. Just looking even one step away from, because Seattle, Washington, they have, like you mentioned, there was a lot of people that were contaminated, or I'm not sure what the correct term is, but they got the virus. I feel like Las Vegas is exposed due to the travel. That's really just taking a complete halt. I feel like Orlando, similarly, any kind of Disney-related stuff, Atlanta, these are robust economies that have a lot more going for them. But when you have a total stoppage of travel, which is what we're seeing, this is why you can get $9 flights to Berlin, for example, from the United States. Those markets in particular are most likely going to struggle. It's just a matter of how short or long the struggle will be.
Yeah, and you're exactly right. We pulled the data yesterday because we were like, okay, if it's going to be mostly the service sector that's going to pull things back, what are the markets that have the highest exposure to service? And you completely nailed it. Orlando and Las Vegas are double the national average in terms of having the highest exposure. And then you see a lot of the other markets across the country, a lot of the big ones that you named off, even LA, Atlanta, they have about a 10 to 12% exposure. So while it is around the national average, you still have to think that it's not just this data does its best to capture it, but then you don't think about all the other parts that are connected to it.
Right.
So I do agree that Las Vegas and Orlando, both markets were doing fairly well. So I think it's a little bit of a shame, but those markets could see it a little bit more. We survey and collect data on sales activity. And as of right now, Phoenix data still looks pretty positive. I think Phoenix was having a really good run going into this kind of turmoil, and I'm hoping that they can continue some of that momentum in the next 3 to 6 months.
Let's talk about China and the implications there. So obviously, they are on a large degree lockdown, and in particular areas, it's just really, really challenging. What are your thoughts on the implications of that regarding foreign investment in United States real estate? Because that's been a big story of the last 10 years, is people moving money out of China to buy properties in well-known markets, very prime markets, Los Angeles, San Francisco, San Diego, New York, et cetera.
So here's my positive twist on a bad data set, is that when you do look at it, if I live in LA and I spend a lot of time going up and down the West Coast, so Seattle and San Francisco, all the markets that you labeled off, well, those markets have already felt and almost have come to a new normal of a pretty big pullback in activity from China. We saw that really happen when the market slowed in 4Q18, and then we kind of haven't seen it ramp back up. So I think that they've gotten to a point that they're more resilient than they were. I think the worst of it really hit both when the housing market slowed, and then I think that Chinese investors were saying, hey, it doesn't feel as much as a safe investment as it did in the past. Then they pulled back. The markets, LA and San Francisco and Seattle are actually still a little bit slower than they were back in 2017. I think it's because of that already. So I'm a little less concerned that that's going to just kind of shatter those housing markets because we've gotten used to it.
Okay, fair enough. Regarding the construction of a lot of homes, a lot of the products which are actually used to build homes in the United States are imported from China. What does that look like on your end? How do you anticipate that playing out?
Yeah, I think that's probably one of the biggest concerns. Again, going into the coronavirus, we saw that the housing market index, that's from the National Association of Home Builders, they basically track builder confidence. And generally, when builders are more confident, they're more likely to pull permits and issue starts and get homes getting built. So we had really positive momentum. It was like, awesome, the market's turning, the housing market, they're going to bring all these homes online. They still already had the fact that replacement land is hard to find, replacement land is expensive. The cost of labor is expensive. The cost of commodities were expensive. But now add in the fact that you have some supply chain issues that maybe those costs are either going to go up, maybe because the supplier needs to charge you a little bit more. We still have some of the tariffs at play. Maybe because you can't get it from China. And the reason you got it from China in the first place is because it was cheaper than here in the US. And so now if you have to switch to a US supplier, hoping that they have enough, maybe that's going to push the cost up. All of these different costs are not good for the new home market because it makes it more expensive. The premium between a new and existing home is incredibly large, and you have to have a good, compelling reason why someone wants to buy a new home at that point.
Yeah, it's interesting, right? So like with the trade war stuff and the tariffs and even the conversations about people moving money overseas, I can guarantee you they don't want to. You know what I mean? Like people don't want to buy their products from overseas. They would much rather buy their products from 3 minutes away from where they work. Totally. As a business owner, I don't want to hire people in the Philippines. If I could hire the same caliber of talent for the same dollar amount, I'd much rather them be in Los Angeles. It's all about price, and there's a spectrum there, and convenience is a huge factor of that. So when the price mechanism stops making sense, it's not good news. It just means that we got a worse deal, right? So like that's what will slow down volume, and it could cause a major problem. I can go into the world of like free trade and stuff, but I'll save that for a different conversation.
For another discussion, yeah. So, and back to your China point, you had directed me one way with the China discussion. One thing I do want to acknowledge too with China is when the coronavirus started happening, I think most economists and researchers were like, okay, just look at SARS. SARS is a recent example. SARS was one that kind of hit the media and then they contained it and everything was fine. I don't remember the exact stat, but you can really find it anywhere. When you look at how much of a share of the global economy China was back then to how much of a share it is today, I think that's where using that as an example maybe is okay in terms of how long does this last, but I don't think it's incredibly valuable into what does it mean, because we're in a very different economic climate than we were back then.
Yeah, and it's a different virus. So Joe Rogan recently did a podcast on this topic with someone that I didn't know of prior to this. He seemed to be very competent, and unlike a lot of people, he didn't seem to have an overt agenda that was just wafting from his perspective. So if you Google Joe Rogan coronavirus, he did a topic about this. One interesting thing about coronavirus, every virus is different, and the interesting thing about corona is that you can get other people sick from the virus for several weeks prior to feeling sick. So with the flu, for example, you very quickly feel ill and stay home, as opposed to corona where you are like, let's go to Lake Como in Italy for a couple weeks and have a good time. Yeah. And you can do that and then even come back to the United States and not even know that you were infecting people this whole time. So that's a huge part of this particular thing. So every single virus is challenging, like the rates at which contamination takes place. It's all very specific to that particular thing. So I definitely suggest anyone interested in the topic, listen to that Joe Rogan, because there are other viruses out there as well, but it's hard to back in and reverse engineer what the damage will be in this particular one.
Well, and I think it's upsetting to me too, how much that, and I do not want to downplay the human loss. Of course, that's terrible and we don't want that for anyone. But I do think that when you look at the mortality rate and everyone says, oh, it's this high number, it's because they're basing it off of, basic division. We are doing it off of known cases. And I just saw a thing where they said, oh, we tested 9 people today for the coronavirus. Not today, but a few days ago. Okay, so you're adding now 9 to the numerator and you still have the same amount of deaths. I just am not sure that the death rate is as high as we think because we're not testing people. To your point, we don't know if you and I could be sitting here and have it right now, and we don't know until we get the symptoms that actually match what they want us to go and get tested for, and assuming that they have the test kits to do it. And that's going to really skew those numbers. That, I think, fuels the fear too, because then we think, oh, this is a really big problem and people that get it are going to pass away from it, I'm not sure it's as high as it's suggested either, which could be good for longer term economic growth if we start to see that numerator start to go up and the mortality rates start to level off.
Yeah, it's really interesting. You bring up a good point. It's outside of my area of expertise, but I know for a fact, if you live your life as if none of these mass hysteria problems are actually problems, you pretty much have a good life. However, if you do the opposite and live your life as if mass hysteria is a massive problem, you have a really challenged life in which you pretty much can't do anything. Having said all that, we are doing this meeting over Skype. So I'm in a position where I can make that claim without worrying too much and just go along with my business. So let's circle back to kind of the economics of real estate and how this kind of ties in. So one thing that we have spoken about previously is kind of the inversion of the yield curve and the implications in terms of recessions. It's to a certain extent psychological, to a certain extent it's objective in the sense that the actual yield curve can invert and we can see that as a sign. What are your thoughts on the current state of the spread between the 10-year and the 2-year and what the implications are in terms of a recession, given that it did invert previously?
Yeah. So as I look at the inversion, and it's so bad because we had talked about it so much at length before, I've almost put a lot less emphasis on it today because of where yields are across the entire yield curve. I think all of them are below 1, if I remember that correctly, and that's unprecedented. I'm not sure we can learn from history based on where things are today because our yield curve and the treasury market is getting impacted by all of the different low rates spread across the globe and what's going on with central banks. I think as I look at the bond market, my biggest takeaway for the housing market is that relationship between the 10-year treasury and the 30-year fixed rate mortgage. And I think it used to be stronger. I think we're starting to see that gap widen a little bit. And again, I'm getting a little bit outside of my space by saying this, but my understanding is the whole thing is that it's an alternative investment. And when you look at mortgage-backed securities versus the 10-year, that's why you've seen that they've been generally tied together. And now you have a lot of the refinance risk. And with the refinance risk, you're starting to see that diverge. And you actually saw that rates ticked up in the most recent release after falling down because these banks are getting just flooded with applications and they can't keep up with it. And to adjust demand, they're pushing rates up. But all of that to say, rates are so incredibly low. The math has literally never been better. And we just pulled up the stats of mortgage rates. We looked at what is the equivalent of going from a 4% mortgage rate to a 3.25% mortgage rate. So that's obviously a huge difference per month, every single month, based on that alone. We looked at what is that equivalent to? And in San Francisco, that change is equivalent to an $80,000 price cut. Yeah. We also looked at what does this put us back equivalent to? And in LA, Orange County, where rates are today, where prices are today, we're back to 2014 levels of affordability. And that's looking at the prices then and the mortgage rates then. So I think putting a lot of it in context and again, thinking about this math, you're back to 2014. Like we literally turned back time in some cases to get back to the point that everyone has been saying affordability has been our problem. We now have a little bit of a push that's going to help drive, I think, the housing market a little bit better than the rest of the economy.
Wow. I really appreciate you bringing that data point up because I hadn't really contemplated it like that, but it makes so much sense. And we are seeing, I saw a news article recently, 224% increase in refinances just from a year ago. But to your point, it's basically like taking money off the purchase price. So you've just wiped away a bunch of appreciation, which has taken place over the last 5 years or something like that. When it comes to the refinancing, though, if someone's refinancing a house, is there any implications or any data that you can share with us about what the implications of that means? Like when people refinance, do they tend to stay in their own home longer, for example?
Yeah. So I don't know if you noticed, I did like a really big sigh in preparation for answering this because I do think that the refinance boom that we're going through today is going to be a systemic problem for the housing market going forward. For one of the things that you mentioned of people staying in their homes longer. Another is if people have their home now, they lock in their rate. You can get rates in mortgages today, your monthly mortgage payment lower than what you can pay in the rental market in some cases. So someone gets that. Then we see a little bit of turmoil in the market, but then eventually we're going to see home prices start to go back up again. With all hope, we're going to see rates go back up again. We're going to go back to a normal economy, whether that's 3 years from now or 5. But those people that have locked in that really low mortgage rate now can hold on to that home, maybe use it as an investment property, and then they go and they buy another home to continue where they want to live. To me, when we look at the problem in today's housing market, it's lack of inventory, and builders can do the best that they can, but ultimately 90% of the market is resale. When you look at resale, a lot of those investment properties now are holding back entry-level buyers who probably wanted to get in on that cheap home, but now it's going to be used as a rental one. So I think that becomes a longer-term issue. I guess good news if you already own a home, but bad news if you're 5 years from now going to buy a home.
Interesting. Okay. And what do you think this means for multifamily then, in particular? I mean, given the fact that we're seeing a lot of drive to the rental space just because of the lack of affordability, even when factoring in these new rates.
Yeah. And the multifamily space is changing a lot. So I guess for one, a lot of the institutionally managed, the big rental spaces, I think that they're going to continue to see success because we just ultimately have too little supply. I think there are pockets of the country where you have a lot of institutionally developed multifamily, plus you have more mom and pops, plus you have more developers doing single family for rent. And now you have this combination of three different product types that are in certain submarkets that may be oversaturated. So I do think I'll use an example of Houston. I know there are parts of Houston that has too much both entry-level housing supply and entry-level rental supply. And I talked to our local expert there who said because of that, you're seeing some concessions in the rental space, a little bit less rent growth than they initially had thought because of this ultra competition. So I do think developers have really pivoted and said, multifamily is more of a recession-proof strategy. We can make the deals pencil. And so they've built more communities, but it really hasn't solved our for sale problem. We just have a lot more rental inventory on the market.
Yeah, absolutely. So, I do focus on have a pretty broad focus, just how we're positioned as a company. We joint venture with operating partners that focus on their particular niches. So I've been able to, I consider myself to be dangerous in due diligence on a lot of different asset classes, but then also defer to someone's expertise when it comes to actually implementing the business plan at the property level. So I know a lot of people that are listening to this show that are passive investors in a lot of different asset classes. I'll just give you my thoughts on some of the asset classes as it relates to this conversation. So I think hotels are very exposed. I mean, we talked about the travel stuff. We talked about the challenges with that. I think retail, depending on the tenant base, could also have some challenges. This is going to be highly focused on the length of time at which the hysteria is at the current levels. At the current, the date I think is the 12th right now. As of right now, it feels like peak hysteria, and it hopefully, to Ali's point, won't increase from here. But things are not going a positive direction quite yet. I went to a conference or a speaking event yesterday. It was basically empty. That's what's probably going on at a lot of restaurants. That's probably going on at a lot of even the quality tenants that we like to see. Mixed martial arts studios, for example, you can't outsource that. Well, those are having some challenges. Mobile home park business is interesting. It's not exposed to the virus as much because the tenant base is less likely to travel. Of course, the counter argument to that is if there is some kind of contamination, it's very likely to be widespread. Self-storage is, in my opinion, very well protected in the sense that people don't go to see the product. It's not a facility full of people. It's just a place full of things. And the lack of movement around the market and the asset class in particular is probably very good. Restaurants, again, really exposed. So that's just my thoughts on some of the things. I really like notes right now. I really like debt. It's not as subject to the volatility in the actual real estate market that could be caused by some challenges. So there's my little perspectives. And I know that was kind of a quick run through, but I feel like some listeners would probably be interested in it. So you're very data focused. That's why we love having you on the program. But I do want to get your opinion, your speculation about how this is going to play out. What do you anticipate seeing in terms of the next 6 months and the next 12 months? We're looking for a prediction that we're not going to hold you to, by the way, but I'm just interested in your opinion.
Yep. So I'll start by, as you were talking, I was like, I forgot to mention what we're seeing with oil prices.
Oh, yeah. Jump in there.
Yeah, let's just go there too, because everything else is falling down right now. So when you look, obviously, I won't go into all the tensions with Saudi and Russia, and the hope is that maybe it's just a little bit of a power grab, and then we end up getting that resolved. But if you think about the markets that have more exposure to oil, In particular, I had already talked about Houston. And I don't want to be overly negative on Houston because I do think that that market still has seen a lot of diversification in the economy. I think that they've had a really strong run-up of the labor market, and so they still are fairly well positioned. But they're now facing all of the same hysteria about COVID-19 that the rest of the nation is. They had to cancel their rodeo 9 days into the 20-day program, and they're facing $30 a barrel oil prices right now.
Right.
And so I'm more concerned about how that market is able to withstand it. And I think we've seen that builders continue to build homes, but sales do tend to slow a little bit as it relates to a change in oil prices and as it relates to a change in employment. I think on the wider economy, as it stands today, and again, we're at like the height of everything again, hopefully, I think that we should expect to see the data turn fairly negative in the next 3 to 6 months. When you look at the actual definition of a recession, I think I've wrongfully, maybe even on this podcast, said what popular belief is, which isn't actually the definition. The definition of a recession is a consistent pullback in the economy spread over a few months in multiple sectors that's usually visible in GDP, retail sales, industrial production, and the employment market. So if you unpack that and you're going to say, okay, definition of recession includes those categories, employment, I think very likely we will see a hit. I think we will see either labor market not growing as much, or we may see some layoffs. I don't think that will necessarily be widespread. I do think it will be concentrated in the sectors that we've already talked about today, but you'll see that. I do think GDP, again, everything we've talked about, the service economy is the largest part of our economy. Consumers represent 70% of it. We see changes in their behavior. I don't know how that doesn't create a problem to GDP. Industrial production, if we're assuming that this is manufacturing, we already saw that it was arguably in a recession. We saw that there was a pullback in all of the ISM numbers as it relates to the trade war, as it relates to, different supply chains still. That's going to make that problem worse. And then the final thing, well, there's another one that we're going to assume also is going to take a hit. So we talked about employment, we talked about retail,
that's a
industrial
lot.
Production. Yeah. So
right.
Again, using logic for me, as you think through those components and you say, if that's what makes up the economy, and if you see those sectors slow, that causes a recession. Hopefully it's not a recession. Hopefully it's a slowdown, and hopefully it's short-lived. I do think we have to be aware that it could be longer-lived, though, and it could be something that usually lasts on average 11 months. So I don't have anything that makes me think a recession will be particularly longer than it is. And if it starts soon, at least we're living through it and we're chugging through it, and hopefully we come out the other side. There's going to be so much demand for housing at the other side. So I'm not really concerned about what the longer term view looks like, because we have millennials that are 28, 29, 30 years old. Right now, they're the largest buying demographic, but they're going to continue to drive that growth because not enough of them own homes just yet. Plus, we have the Gen Zers that are now turning 20. Okay, maybe not right now. Some of them will be buying homes, but not a large share. But 5 years from there, there's an even better demographic tailwind adding to what we're already seeing with millennials, plus baby boomers changing their life stage. So I'm really bullish on the long-term view.
Man, I really appreciate you going to that level of detail. I think a lot of people are going to be really appreciative of that. I do want to wrap up in a second. I want to be respectful of the time, but just anecdotally, over at Meyers Research, are you guys continuing business as usual, or are there any things going on? Are you working from home? What are your thoughts on that?
We're still at the office.
Yeah.
And most of the changes that I have seen have been from other organizations. I get either, like I said, paid to do presentations, and those have been the biggest changes I've seen right now. Of people just saying, hey, let's just hold off for now. I'm sure we'll put through some kind of travel restriction at some point, because I know that our employer is mostly just concerned about our safety and doesn't want us to have to feel obligated to go on planes. But it wouldn't be unique if we did that. I would say most of how I had said I did a lot of presentations in the past month, a lot of people that I talked to said, this is going to be the last one I'm going to because my company has put a ban on it.
Wow.
And so we are seeing a lot of the bigger companies just saying, hey, let's just hold off for now. We don't want you going to those conferences. We don't want you on planes.
Understood. Hey, Allie, thanks so much. I know I'm always trying to push you to come on and talk about these interesting topics, so I really appreciate it. Before we jump off, let the listeners know how they can learn more about you and your firm and your podcast as well.
Yep. So we are at Meyers Research, MEYERS LLC.com. I just created a Twitter a few months ago. I have close to no followers, but if you're on Twitter, I do some activity on there. It's at Allie Wolf Econ. And I post a lot on LinkedIn. A lot of our research goes there as well. So those are the three key things. Feel free to send me an email. If you disagree with me, I'd love to hear it. Do you agree with me? Cool too. But I think we all learn by not believing the same thing and challenging what we've heard. So feel free to reach out.
Awesome. We will link to all that in the show notes page. Allie, thanks so much.
Thank you.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.